With us, let's take a look at some of the business news. This week saw a lot of activity in the markets, but the JSE was a little changed today despite some pressure on global equity markets as gains by banks and retailers were offset by rent hedges and miners. The oil price edged a little lower while the prices of industrial metals were under pressure after data earlier showed that Chinese industrial production growth fell to a 17-year low in May. The rand was a little firmer at 14.83 cents against the dollar. Brent Crude oil was at $61.12 a barrel. So let's analyze some of the highlights of the week with Ngoni Gwatidzo, who is the Chief Investment Officer at Financial Services. Thank you very much for coming to our program, sir.
Thank you, Colin.
Well, let's take a look at the oil prices, which have really been falling, so inducing the possibility of a decline in petrol prices.
Yes, I think the oil price has been affected by two things. The first is demand for oil is presumed to go down as the economy's, global economy slow down. The second thing is that the U.S. has been producing a lot of oil of its own, and it's now a net supply of oil. So that is tended to put a damper on the oil prices. All
right. So the rand was at some stage on a back foot,
yes,
but it looks like it's going to recover for a while. Tell us about the push factors of the currency movement.
Well, the one thing about the rand is, as you know, it's a fluctuating currency. For now, what has been making it slide are domestic factors, which we have all been ventilated, political developments, which have been negative to the markets, and also what we have been seeing is that the US dollar itself has actually also been strengthening a bit, and because of these tensions, and that has had the impact on the rand.
So at the moment we have been looking at some movements in as far as the global macro trends. Yes. What has been influencing them?
Well, currently what we see is, if we start with the United States, we think that the economy there is slowing down. It might not go into recession, but there are signs that the economy is slowing. Inflation is coming off. There's no pressure on inflation, and unemployment is actually also at record levels there.
Mm-hmm. Isn't it surprising to you, though, that the protectionist stance of Donald Trump could have induced some economic performance? Wouldn't you by now seeing an uptick in the numbers?
Well, I think the jury is still out in terms of the impact of protectionist policies. Of course, Donald Trump wants to think that this is going to, help the U.S. economy grow. But we think that there are other factors, because what happens is that there are certain sectors, for instance, which are actually suffering. The farming sector, for instance, is actually reeling under these protectionist policies. So we don't think that it is something which is going to make the U.S. economy stronger than it was before. So
how are the trade wars really playing out? Because looks like Donald Trump is very aggressive in his statements when he tweets, and influencing the markets on the downside.
Yes.
And China also being very careful when it responds. What do you make out of how they're going to really affect the markets?
I think if we start with, let's start with the US. Donald Trump is also facing an election, as you know. And there are a number of, there's a possibility of inquiries, and even some talking about impeachment. So he is trying to talk the economy up so that he would be seen as a strong man, and therefore, he is untouchable. If we go to China, China is planning to become one of the superpowers, and they are not reneging on that. They are doing everything possible. For now, they are actually pumping a lot of liquidity into the system to ensure that the economy doesn't collapse. Of course, you saw the numbers which came out this afternoon on China. It's not unexpected. But I don't think the Chinese are phased, because they are determined and hell-bent also making themselves sort of a formidable power.
So moving across, what happens in Britain in as far as Brexit is concerned as Boris Johnson prepares to take over? He's promising that he will deliver Brexit by October, but what happens in the meantime?
Well, if you recall, Boris Johnson has been one of the harder Brexiteers, so to speak, and that we don't actually expect much from him other than the continued impasse in terms of the negotiations with the EU. It won't come as a surprise that the British actually come out of the EU without a deal. And as I said, I think he's one of those people who has been driving very hard in terms of Brexit.
So now let's go back to now the issues of the local markets.
Yes.
In a balanced fund, looking at investors, where is it advisable for any investor to go, and which are the no-go areas?
Well, at this point in time, what we would say is that we would adopt a more neutral stance of some sort, depending on your risk profile. But what we could say is amongst equities, we would be underweight domestic equities, particularly retailers and your diversified industrials, for reasons which has to do with lack of production on the manufacturing side. Of course, we saw manufacturing figures ticking up a little bit, but we don't think that that is a significant trend forming up. As they say, one swallow does not make a summer. Now,
just for a wrap, let's look at resources and industrials as well as financials. What do you make out of that?
The market has been driven by momentums. And we have seen more performance out of your mining sectors, because commodities have been ticking upwards. Your prices of copper, nickel, and other base metals has actually been going up. That's the one aspect. The other aspect is the one which we spoke about, the rand earlier. The weakness in the rand is good for commodities and eventually mining producers. We have also seen, because of the tensions in the Middle East, a spike in the price of gold, which has helped your gold counters, your Anglo Gold, your Harmonies, your Goldfields. So that's why there's been a tick up in the mining sectors.
Okay.
The banks have also, I think, they haven't been too bad a place to be. They've been kind of defensive. I think the one thing about banks is that there is an anticipation that interest rates might be cut. And of course, it hasn't happened as yet, but I think that lower interest rates are good for banks. Right. And also the fixed interest sector. It is one area where you don't like not to be.
Okay.
Because of that.
All right, so much to talk about, but thank you very much for making time to speak to us.
Thank you very much.
All right, that's Mr. Gwatidzo, Ngoni Gwatidzo, Chief Investment Officer at Weaver Financial Services, wrapping up the week that was right here on SABC News.